Hi, everyone. Sorry I'm a few minutes late on this one. Really big apologies for that. It's because I wanted to get all the data up and ready for you. Let me know you can see and hear me entirely clearly. We're going to make this really nice and simple, do a roundup of last year, but with a view to the lessons you can take into next year. Let me know where you're from. And again, a big apologies for being late, very unprofessional of me. It was just because there's so much data I want to get on to the screen, and I got a ton of it for you as well. You'd be very pleased to know. So I can see there's a whole bunch of you from, we've got Durham, Switzerland, nice to see as well, Bonnie, Scotland. As well. So thank you all for joining. And I've got a few things in terms of files to share with you, which I will also do as we go forward on all of this as well. Okay. As I say, there's quite a bit that I only just got ready. And hence why so much is a little bit late. Now, investment lessons to take. I'm also going to give you the market update as well. So you're going to get all of this and the latest data on the market update. Let's just kick off with some of those lessons we want to take into 2025, which will help our pensions, help our performance, help our returns as well. Andrew in Thailand, you lucky man, at the moment. Good to see. And we've got a good number of people on here as well. Remember, this is not individual advice because I'm not speaking to you individually. I'm speaking to you as a collective. It is for education. It is for information. Please do not consider it a solicitation to buy or sell individual stocks. And I hope in 2025, at long last, to get my next Financial Times book out, Forecasting Share Prices, which is long overdue. It's the one thing I didn't forecast was how long it was going to take me. So wonderful to see you all. Now, lesson in no particular order. Okay. And before I go into the first one, which is to be aware of IFAs, wealth managers and fund managers for your pension in 2025, and they're going to be coming at you strong. And the reason is because the markets were up last year, so they'll use the advertising for the markets to grab your money. You're going to get more adverts than you've ever had. But before I go into that, I want to give you a slightly different lesson, okay, on the markets for 2025. Which is, you're going to hear a lot of people saying, oh, they're expensive, they're expensive. This is where you're paying $28 for every future expected dollar of Microsoft profit. So if you buy a share in Microsoft, you're essentially paying $28 to buy that share, and that one share represents $1 of future expected profits. So you might say, well, why would I pay $28 for Microsoft when I could just pick up JP Morgan for significantly less? I could pick up JP Morgan for $14, for instance. And the reason is valuation is not the only metric. So when you read all those panicky headlines, you're going to get IFAs and fund managers, you're going to get journalists saying to you, 2025, be warned, it's so expensive, there's going to be a crash, there's going to be a crash, and we'll come to that in a second. And they'll base it on valuation. They're looking at one side of a jigsaw puzzle, one side of a Rubik's Cube. You'll instantly know they're stupid, okay? Because if anybody only looks at one item of information, then they'll be forever trying to pull you out of ever investing, okay? Because valuation is not the only factor. Growth, for instance, is future expected. Turnover, sales, profits are all relevant factors. So it's incredibly important you don't fall foul of that. So that's lesson number one. Do not be worried about all the people who are going to be talking and trying to convince you that valuation is the only metric. The other thing, just to give you a quick update of how the past week's gone, it's been relatively green. The past year has been relatively good. Now, the next lesson is, do we know what's going to happen in the year ahead? No, we do not. Now, you might say, well, bloody hell, am I bullish or am I bearish? I'm not bearish, because we're going to get our portfolio right, where our risk and money management is right, i.e. we've put the right amount of money in the individual stocks, and And should there be a tailwind, we should do well. Should there be a headwind, we won't. That part's out of our hands. The ones who gamble don't look at everything. So the lesson for 2025 is we're certainly not going to be gambling. What we're going to do is be well aware of the fact that, see that blue dotted line? The blue dotted line, which is a measure of short and medium term average prices, and that's the S&P 500. We're going to be well aware of the fact that it's a little bit like this time 2 years ago. The market is almost identical to that. And yes, it can fall, in which case we will hold cash. We are making no predictions as to what will happen in 2025, other than should the market continue upwards, which it may well do, our stocks, because they're undervalued, good growth will do well. But should this pattern repeat itself, which it's not looking like it is at the moment, but the average prices start falling, that starts falling, we will go into cash as early as January. Understood? Now, how do we know? We know, and this is an important lesson for 2025, we know not to make our judgments prematurely. We don't anticipate that happening. We will wait for it to happen first. Okay? We will wait for it to happen first. Richard from California, welcome. Lovely. Simon Munhill as well. Donald Sirhill, Andrew, Warren, Karen, welcome one and all. Okay, so another important lesson. You might want to write these down because I've not had the time to put them all on the screen, and I will put them on in a future broadcast. We do not pre-anticipate what's going to happen. Our alternatives, important lesson for 2025, our alternatives are to either hold or be in cash. They are not to try and find some miraculous thing which doesn't exist. One of two things will happen in 2025. We will either be holding cash because this pattern happens and that's what we're going to look for, or it'll continue upwards, in which case we will hold. Okay, what we'll buy, in case you're not owning anything at the moment, I'll explain in a second. So that's a very important lesson going forward. It's a subtle lesson that people miss. They think we have a crystal ball to see into the future and know which way the market's going. No, we have checked enough information, which I will show. We have checked enough information through our spreadsheets. We have checked enough information. None of these are good enough because they don't hit all our greens. We have checked enough information that we and put sufficiently small amounts into each company, and I'll come to that in a second, that if there's a tailwind, we should do well. If there's a headwind, we won't. I've got the numbers, the indicative numbers. I had a quick look before Paresh, before this email started. Paresh has sent me the numbers for what our January list looks like to now, and there's still a day or two to go. We're up over 30% if we just put equal sums into our entire January filtered list. That's not the further filtered, just the filtered. The further filtered should be better. He'll get me those numbers in a second. Now, I'm not projecting that's going to happen in 2025. I don't know. What I know is we will tick all our boxes, and if there's a tailwind, we'll do well. If there's headwind, we won't. Got it? Now, it's a very subtle difference to what people think we do. People think, oh, we're very clever. We're like journalists. What we do is, journalists aren't the cleverest people. We know that. What we do is see into the future and we know these companies will do well. No, it's not what we do. Okay. This is the year-to-date performance. It's pretty much similar. Another very important lesson for 2025, which I'm going to take into 2025, is there's about 7,000 exchange-traded funds. They tend to have less volatility to the downside because they're funds. I'm going to show you some of these. 7,000 odd funds. We're probably going to have more money in some of these funds. Why is that an important lesson? See this, we want all of these things to be green. We want them to have high sortinas, that's high average returns, low falls. The reason I'm transparently showing all of this, okay, not most of these don't make our list, by the way. This isn't our filtered list. The tab which is filtered is the one there. Okay, these don't make our list. The reason I'm showing, and there's a lot of leverage ones, I'll come to leverage in a second as well. The reason I'm showing all of this is we filter from these down to about the best 100 funds. Why? because their volatilities tend to be a lot lower, right? Let me explain. See that volatility, 5%. To give you an example, Microsoft, probably the safest company I can think of, has volatility about 12 to 13%. This has got a 15% return in 6 months. If you get 15% in 12 months with just that low volatility, you might be very happy indeed. So we're probably going to spend more time looking at exchange traded funds going into 2025 because they give us a lot of variety, because we've got a lot of clients who want less volatility. But here's the important lesson for 2025. We will continue, because it works so well in 2024, making sure we project forward only those funds, exchange traded funds, okay, which you buy and sell like stocks. There's 7,000 of them, which project forward on their existing trends at least a 40% return and don't have downside falls more than 20%. Where will we do that for you? We will hand feed you these. If your clients will hand feed you these, where will we do that? We will look at the projections going forward on those and then project forward to see, well, if they hit that, can we get our 40%? If we can't, then that fund may not be for us, or a leverage version of it might be, and I'll come to that. Equally, we'll look to see, is there a risk of a 20% fall? So we've got double reward to risk. So we're going to spend a lot more time looking at the various funds, just because I want less downside volatility because the market's a bit overbought. I want still that upside gain. And the other advantage of these funds, if I give you some of the names, I love the names. Okay, I'll give you some of the names. They go everything from coffee, if you were so minded, all the way up to financials, technology, ultra industrials. Okay, my point being infrastructure development. My point being, through a basket of stocks, funds. I'm not talking about your St. James's Place investment trust. Don't do, lesson from 2024. Don't do investment trusts. Don't do that. Okay. Do not do active fund manager investment. We're talking exchange traded funds, which are trackers. I first wrote about them in my Financial Times books, my columns rather, 25 years ago, and then wrote about them in my books. And I'll make sure you all get copies of the books in this webinar as well. Okay, so that's going to be a very critical lesson going forward, given that they have low downside volatility, given that the upside in the broader market might be somewhat limited, given how much money we've made this year. We can't keep making ridiculous sums of money every year, presumably. Otherwise, we'll all be trillionaires, and God doesn't like it like that, apparently. So given that downside risk, we'll want to look at more of those ETFs, okay, into 2025. Now, there's a few other lessons I want to take in before I go back. The next lesson I want to get over to you is I'm looking at the past year performance being something I can achieve over the next 2 years. Okay, you might as well, it's a bit rubbish. I thought you target 40%. Yeah, any stock or fund to be in my portfolio has to reasonably, on a current existing trend, after we've looked at value, growth, income, cash flow, Sortino, after we've looked at all of these factors, and none of these meet my requirements. So you see how much we ditch away. We're sort of like the banana picker who says, nope, not good enough, not good enough, not good enough, not good enough. We're sort of like the Harrods food hall. Not good enough. That's not good enough. That's not good enough. The point is, after we've picked all that, ticked all those boxes, all of these are green, we still need that 40% projection to the upside. Doesn't mean they'll achieve it. In a tailwind, yes. In a headwind, cash like 2022, and we get 0%. Do you see what I'm saying? There isn't a guarantee that they'll continue. Anything will continue. I'll explain that. But what I am on the downside, my bearish case, my worst case, is this performance of the past year will, over the next 2 years, be replicated. So I should get 30 to 35% over the next 2 years. Worst case. What's the best case? Well, bloody obvious. Get 30 to 40% in 2025, 30 to 40% in 2026. That's obvious what the best case should be. Okay. Actually, the best case would be 2 times leverage Tesla and hold it for 2 years, and 3 times leverage S&P and hold it for 2 years. But who's got the balls to do that? I don't. Okay, so those very important points. What do I expect over the next 2 years? Worst case, that my pension will be up by about another third. Again, worst case, and I'll tell you why in a second. Best case, well, obviously we'll replicate last year, next in 2025 and in 2026. Obviously, that's how we look at it. Can I guarantee that's what's going to happen? No. If there's a headwind and we get 2022, we'll get 0% and we'll be holding cash all year long. If we get 2023, 2024, we'll continue doing what we did in both those years. It's very simple, and keeping it simple is our job. You can see the choice of exchange traded funds, going back to that lesson for 2025. Look more at the funds. We've certainly got more clients who want to have that risk aversion, which still gives them coverage, but absolutely critical to doing that is value growth. Well, Sortino Alpha, making sure those projections of 40% are in there. You can't just randomly pick any old thing. Another sort of lesson for 2025, I'm going to come to the UK markets in a second. Let me just pause that bit and go back to some of these other lessons. Okay, and I'll come back to the market lessons in just 1 second. I also want to make sure I have covered absolutely everything that I wanted to show you. Wait a second, Alpesh. There we go. Here you all are. You're all over. I want to make sure I've got your chats over here. What happened to Santa Rally? We can't be greedy. We're investing over 12 months. Not really bothered what happens over a day or two, are we? We're not really bothered what happens over a day or two. So here's an important lesson. This is going to happen in 2025. Whenever the stock market has a good year, the marketing agencies for the big asset managers go mental and try and get your money in. This is going to repeat itself. I guarantee you this underperformance by these fund managers, these funds and these providers is going to repeat itself in 2025. I will give you a guarantee they're going to do the same mistakes because they are institutionally handcuffed. They're institutionally handcuffed. So my warning to you will be they will underperform yet again. These are going to be the worst culprits. I will guarantee you that. Okay? Why can I guarantee they'll have this underperformance? And don't forget, a fund manager, for the beginners on here, that has investment trusts that they put your money in through an intermediary like a brokerage like Hargreaves or a St. James's Place or an IFA, that's different to an exchange traded fund. An exchange traded fund tends to be a tracker. They don't have a fund manager behind them. So the biggest problem that these companies have, as I've mentioned time again, I'm not going to go through in great detail, but guaranteed for 2025, St. James's Place's failings are going to be my opportunity. They've got 900,000 clients. That's going to be a huge opportunity for us for this very simple reason. I'll give you the explanation on this. You should be able to download it. Okay, they're going to continue I guarantee you they'll continue getting mediocre returns because we've seen it year after year. Whereas because we're focused on being able to narrow down from 10,000 stocks and 7,000 exchange traded funds to those with a projection of 40% to the upside, which they're not allowed to do. They just won't do it. They have to give you only UK funds or only US funds. They have to pick from a very narrow group, okay, because they're handcuffed, right? So they will continue having mediocre performance. I can pick a football team, basically, from all the best players in the world. They're only allowed to pick from people born in Watford. Now, I don't know how well Watford's doing in the league, but got a pretty good idea. Okay. They're going to keep charging layer after layer of fees. This is one of the other reasons. This is 2025. I guarantee you they're going to buy more of their own funds. Now, I've exposed this on my YouTube videos. What they do is they have a fund they put you in, and then that fund, so take St. James's Place, buys another St. James's Place fund. So the top fund charges you fees, gives its money to a second St. James's Place fund, which then charges you another layer of fees. That's how they're making profits. Okay, and I've shown that on my videos from the data as well. Kid said, can ETFs be rebalanced overnight? And does this make ETFs higher risk? Now, if you look at the easiest way to look at ETFs is just look at their volatility number. I provide the data on their volatility number. So if the volatility is low, then volatility and risk mean the same thing. If the risk is low and the volatility is low, they go hand in hand, and you'll just see the data. Just follow the data. Okay. The other thing is they rely on client dependency, whereas what I do is try and empower the client. I give you the education and the data, so you've got it and you know what to do. Okay. One of the reasons they're going to continue underperforming is they've got restricted offerings, right? They will promote those proprietary funds they own because they can make more money, or the ones they get the most fees from. A bit like a pharmacist or doctor in the US who will sell you drugs where they make more money out of it. All right. It's the same as that. I don't have time. I'm completely independent. I don't have a conflict of interest with you. Right. Their focus is preservation. In other words, they don't want any downside volatility, which means you won't get meaningful growth. Whereas clients, some of them want growth. Others do want preservation, which is fine. Others want a balance, right? They won't give you the growth because they don't want to have the volatility. The reason they don't want the volatility is because you would leave them. Okay, so they'd rather that you suffered an opportunity cost than an actual cost in exchange for lower growth, right? They target high net worth, so isn't really that much of a problem. I'm open to anybody. Lock-in periods, that is possibly illegal. The lock-in periods that they have and the penalties they charge. You should be in charge of your own money in your own SIP and ISA with whichever provider you choose, and you should be able to go into cash or change providers anytime you want. That libertarian attitude that I have to your pension is what the industry should have. Instead, they lock you up for no good reason, absolutely zero reason other than they can predict their own income and their own profits. That is unfair. That is absolutely unfair. Okay, their financial models are from the 1960s. I've seen the exams there, multiple choice exams they have to sit. Now, I won't go into all of them. I've done a similar one for IFAs, which is very similar to what I've said. The biggest problems you're going to face in 2025 with IFAs is they're going to continue giving low returns. We know that because there might be a headwind in 2025, which means they're really not going to be able to rely on the fact that the market's going up. As Warren Buffett said, when the tide goes out, you see who's been swimming without shorts. A lot of IFAs are going to be caught with their shorts down. Okay. They're also going to continue using this traditional 60-40, which has been shown not to work. It doesn't work because people want better returns, because they see the returns their neighbors are getting. They see the returns which are out there from big companies, and they say, why haven't I got those? That problem is going to continue into 2025. So I warn you now, more people are going to be unhappy with our IFAs. There's going to be more journalist stories about IFAs being absolutely bloody useless. And more people are going to get frustrated and going to think, I should have moved earlier. I should have moved earlier. Okay. So be very, very careful with them. Now, before I go back onto the market, we've avoided these problems by not having any of those conflicts of interest. And by making sure people have the information, transparency. Why would you not give people the data and the education? IFAs and St. James's Place won't ever do that. It's because, and this is what this person said, started in great investments program in March and didn't start investing with my ISA until April, which is currently up 6.3%. That was somebody who started a little bit late. Started my SIP in June. It's up nearly 13%. I didn't get that over 3 years with my IFA. Now, they've gone for a very low risk, low volatility, which you can do. Nothing wrong with that. They beat what their IFA did in 3 years within 6 months on mine. Okay. That means you don't need high risk. You can have low volatility and still get good returns. Similarly with fund managers in 2025, I guarantee you they are yet again, because it happens every year. And Eugene Fama got a Nobel Prize in economics for making that point that I've put in red, that I've circled. I've written about it in this book. I've written about it all the way in that, which was 20 odd years ago, more than 20 years ago, which the FT published, and in my articles. It was Eugene Fama's work I was repeating, and he went on to win the Nobel Prize in economics. They will continue doing this because they are handcuffed. They can't go into cash in years like 2022. They spray and pray into a whole bunch of stocks. They look at an index and they say, right, let's go a little bit overweight in this, a little bit underweight in this, as opposed to let's focus on the best companies globally from a global list of companies, because that isn't ever their remit because they got so much money under management. They couldn't have a remit of only having 20 stocks, because if they did that, they'd end up owning some of those companies. And the few funds that do have a remit of being able to concentrate on a few stocks end up only having so much capital, they can only go into a few big companies, whereas you don't have that problem. You're your own fund manager. I want to make you your own fund manager, whether you're in retirement, sold your business, a busy professional. Find a quick way for you to manage your own fund. Look on your phone, look at the results every 2 weeks and go, right, okay, all's fine, nothing to do. And most weeks there should be absolutely nothing to do. So I've put that one up. I'm going to put the book up as well for you, so you can download that. You should see a link to be able to download the book. Second, well, another lesson for 2025, and this is going to be critical. When I was on Bloomberg Television, when I used to do my weekly show on Tuesdays and Wednesdays on Bloomberg, I always used to say during the dot-com boom, I said the three causes of crashes, I'm going to come to that in a second. But I said the one thing you want to look for in the dot-com bubble for waiting for it to burst is when people start focusing on earnings. Then we're in trouble. Okay. Now, at the moment, earnings, which are in red, justify the returns to some extent. If profits start missing, all you've got, earnings and profits mean the same thing. All you've got to look for, and if the US market falls, the rest of the world catches a cold. Okay. So what happens is, I'll come to that on Schwab. I've worked with them in the past. Good firm, good broker. What happens is, if those earnings don't keep growing, then there's a problem with the market. Now, one of the reasons that the US market's risen so much is because their earnings have risen so much. Okay, it's as simple as that. Their earnings have risen. Profits have risen. If profits don't rise, we've got a problem. There are only three things, I've said before, cause a market crash. And in 2025, you've got to watch for these three things. Now, I can't see them at the moment, but one of them is more likely than the other two. Okay, the three things are the same three things that make up any company's accounts. Now, think about it. What's the stock market crash? It is stocks, i.e. companies, going down in price. Well, what should determine their price? Surely one of the things would be their accounts. What's in their accounts? All companies have three sets of accounts: balance sheet, which is their assets; profit and loss account, which is earnings or losses, okay, and cash flow statement, how much cash they're coming in and out, right? So three types of crashes to watch out for. One, the 2008 financial crisis was a balance sheet crash, because we discovered that the banks didn't have the balance sheet, the assets they thought they did. They'd valued the assets they had, all those homes, those mortgages, gazillions. And everybody said, well, that's not worth that much all of a sudden. That's a balance sheet crash. That doesn't look like, do I reserve the right to be wrong? Doesn't look like that's going to be the cause of any sharp falls in 2025. The next one is a cash flow crash. Now, when did this happen? COVID. Shut all the businesses, there's no cash flow, stocks fall. Cash flow crash, does that look likely in 2025? Well, it's a bit like the Spanish Inquisition. Nobody ever expects it. What might cause a cash flow crunch? I don't know. I didn't see COVID. Not my business to know what's happening in the laboratories in wherever it was in China. Okay? The point is, we won't know where this is going to come from. Now, you might say, well, surely your job is to be clever enough. I'm not that clever. I don't have that time machine. I don't have that crystal ball to know. But I do know where the beginning and the rumblings. In other words, I'm not a Formula One driver, but I can drive on the motorway and know when there's fog because I can see it. All right? So I can see when it's in front of my face, but I'm not a weather forecaster or meteorologist that I can see it 200 miles away. That's the difference, right? So I can see it when it's in front of my face. And that's better than most people, because most people crash, go through it, and they don't even know they're in it. Now, the third crash cause, which is the one most likely, and by crash I just mean 2022, is earnings, P&L. That was the dot-com bubble bursting. There was a lack of profits. People looked around, thought stock market's nonsense on stilts. What the hell's going on? Okay, so for the lawyers, you'll get that reference. So 2025, warning, keep an eye on earnings, okay? That is probably the best thing I can say to you. I'll keep repeating it. Here's another lesson. We will be cautiously optimistic, but this is probably the most important lesson of 2024 I want you all to take. And it is this. You've got to know your risk profile first. Are you risk averse? Because if you are, your decisions are simplified. If you're risk neutral, they're simplified. If you're risk loving, they're simplified. Now, let me explain some things in subtlety, which I've come across with my clients, which have helped them tremendously. And it's going to help you. Everybody thinks they're more risk loving than they actually are. On a scale of 0 to 10, they all think they're a 7 or an 8. Knock off 2 points. You're usually a 5. So if you think you're loving, you're usually neutral. Okay, very few people I know are actually loving. I've got a couple of clients who are risk loving. Dinshaw, if you're listening, that's a risk loving client, but he knows he is, and we really worked hard to I made sure double, triple, quadruple check. Right? If you're risk averse or neutral or loving, it's fine. It doesn't, and this is a really important point people don't get. Okay. If you are, in fact, let me just put my screen on. I can put this on. If you are, and this is probably the most important point I'm going to make to you guys because it'll save you so much time watching this. Okay. If you are risk averse, it doesn't mean you're going to get worse returns. It means you've got less choice. Let me explain. This is what people don't understand because they think, oh, surely if I take more risk, and this is one of the BS things they've been told by their IFAs and all the rest of them. But let me just prove to you with just simple logic and mathematics. Okay. You've been told, oh, surely if you take more risk, you'll make more return. Sure. If you have something which is more volatile, it might end up high a lot or down a lot. Statistically correct. We don't want that though. That's like saying, hey, if you take more risk crossing the road with your eyes closed, surely you'll make more money. You'll get through better across the road. No, you took more risk. You didn't get a better return. If you are more risk averse, which means you want less volatility, and I'll show you on the screen what I mean by working out your risk appetite and deciding all of this, and we have a very clever way of doing it, okay, then you'll just have to look harder to find the things with less volatility. None of these, by the way, meet my requirements, none of these stocks. You'll be looking for the ones which aren't in pink. You'll be looking for ones which are 3%, 5%. Okay, doesn't mean necessarily lower returns, because if they also have lower returns, you won't include them. So lower risk or risk aversion means less choice, might take you a couple of months to fill your portfolio. Now, I'm risk loving because I'm more experienced. That doesn't mean I'll necessarily make more money than you. What it means is I can fill my portfolio quicker. So how do we decide, okay, on these things and our appetites and what to look out for? And this is an important lesson from 2024 for 2025. I want you to write this down. Drawdown danger, okay, equals duration times drawdown. Now, what does that mean? What it means is this. To determine your risk appetite, you can look at a free resource like TrendSpider or TradingView or Yahoo Finance. You can look at the drawdowns in a particular stock. So if you haven't got the volatility, you look at the drawdowns and how much did it fall and how long before it got back to break even. Drawdown danger is drawdown, which is peak to trough fall, and duration. Okay. Now, if that's too difficult for you, I do it for my clients anyway. If you're not a client, I'm afraid you've got to do it yourself, right? Why is that important across 10,000 stocks? Because then you can work out for your risk appetite, the downside risk, because you assume what happened previously. It's not guaranteed to happen again, but you assume the worst will repeat itself, because it's a fair assumption to make, isn't it? Pretty good assumption to make. Okay. Assume the worst will repeat itself. Safe assumption to make, right? That way, you now know for your risk appetite that your numbers are, and work out your numbers for 2025. If you're risk loving, your numbers will be 25 to 30% drop and 6 to 9 month recovery, and you're happy with it. If you're risk averse, and write this down, your numbers will be 15% on an individual stock drop. On an ETF, it'll be 10% drop. And on an ETF, it'll be a 3 month recovery. Okay. hard to get smaller than that. If you're risk averse on an individual stock, it'll be about a 5-month recovery period because you can't get tighter than that. Okay? That's the difference between risk averse and risk loving. And the benefit of that, of what I've just said, is you won't have things in your portfolio that make you throw up. Of course, to get to that, and that's just the drawdown, and looking at the charts, you would want to make sure they tick all the boxes. First, you don't just look at those factors. On the upside, you'll be projecting forward for 40%. If you don't see the 40%, you don't go into it. It's not guaranteed, but if it's not even projecting that, then you're taking too much risk. What is risk? It is where we step into the unknown, information we don't have. That's when we're taking risk. If that information turns out to be in our favor, but we didn't have it, then we got lucky. Luck is information we didn't have or couldn't have, which worked out in our favor. Okay, gambling is not looking at relevant information, right? Now, that's going to be really important. So I want you to work out which of these you are. And most of you will be these. And once you know your numbers, it'll be easier to select. So now we do this for you if you're on the the Great Investments Program. What else? We're cautiously optimistic that it's going to be a good year because Wells Fargo and all the big banks keep telling their clients, this is what's going to happen. They're all incredibly positive. I'll answer the questions at the end to the extent that there are any questions. Apologies. Okay. Deutsche Bank sees 17%. Now that gives us a good tailwind. Doesn't mean it's guaranteed to happen, but we're cautiously optimistic. What do we take into 2025? Well, from 2024, what we take is we've had over a 20% gain in the S&P. You can have a third year where that happens. So we're cautiously optimistic that we know about the dangers of what I call a daddy bear and that the market could fall. We take this cautious optimism into 2025. Okay? That's the idea. We also take into 2025 that our number one job, now this is going to surprise you. It's a bit like when the Prime Minister says, my number one job is the security of the nation. Okay, my number one job is not what you all think it is. It is not to come up with some magical companies that don't exist that can go up even in a market fall with no volatility and guarantee you that. That's not my job. My number one job, if somebody put a gun to my head, is to make sure I can tell you in these years, be in cash. I'm a bit like a life insurance policy. Hopefully you'll never need me, but if you do, it'll be infrequently. Or a seat belt. I'm not actually meant to be there every second of every day, because once you've got your portfolio, you sit back for 12 months, and then another 12 months, then another 12 months. Now, should that be likely? See those? Because the upside takes care of itself. I'll take the credit for the upside, of course, but it won't be me. It'll be the good companies. My job is to point out where the daddy bear is. Now, I've mentioned what daddy bears are when short and medium-term prices are both falling from a high trajectory. And that's what I'll keep an eye out in 2025. That's my number one job in 2025. Okay? Is to make sure I can go into cash. Now, your IFA and your pension fund manager will never, ever, ever, under any circumstances, tell you to hold cash. Well, they claim they will. They'll say, oh, no, you don't know what we do. We also advise on wills, okay, to try and distract you from their core job. They won't tell you to hold cash because they don't earn money on cash, okay? They certainly don't earn fees. And guess what? VAT on schools have gone up, so their kids' school fees have gone up. So they can't tell you in 2025 to hold cash. They've got all these fund managers, wealth managers in 2025 have got the biggest incentive not to tell you when to hold cash, even if the market's falling. And the biggest incentive is VAT's gone up on private schools, and their bloody kids are all going to private school. So they've got a massive reason they need to see more fees, and they're going to market like crazy. Lesson into 2025, recessions can be good for stocks, okay? There won't be a US recession. There will be a UK one, okay? There will be a UK one because our tax rates, taxation and our general optimism is pretty low. But recessions can be good for stocks. We know this historically because the stock market anticipates exiting a recession. So I'm not going to ignore the UK markets. People sometimes say, oh, you don't look enough at the UK. Well, actually, no, we do look at the UK. Okay, there will be some companies. I'm not picking any of these. I've not looked into these. And we will, as you will see down here, we have FTSE small cap, FTSE 250, FTSE 100. We're looking at hundreds of, how many are we looking at? About 500 UK companies we look at. But very few of those 500, as you can imagine, are all green. Whereas when we include in all the US ones that can go into my SIP and ISA and all the ETFs, I've got 17,000. So pick the best 20 stocks from 17,000 or the best 20 stocks from 500. Guess where I'm more likely to be successful? By narrowing down and filtering from 17,000 than I am from 500. It's like saying, pick the best football team from everybody in the world, or just pick it from people out of, as I said, Watford. Obviously, if you picked it from people from Yorkshire, you'd have a really great chance. Now, here's another thing, okay? The S&P I've mentioned, the number one thing in 2025 related to what I just said about my job to make sure when to go into cash is watching this. Okay, I'm going to watch for that pattern, that daddy bear pattern. I've discussed it elsewhere, so I won't go into it, and it's the same with the NASDAQ. Until then, I am happy having 3 times leverage and 2 times leverage on the S&P 500 and 3 times on NASDAQ and in my son's junior ISA and my wife's ISA. I don't have that problem at the moment. Okay, Mark, your pensions with St. James's Place, the whole sort of reason I exist over the last 25 years with my 200 FT columns and my books is because I want people to learn to do it themselves using SIPs and ISAs. The government created SIPs and ISAs for you to do it yourself. Okay, so, and I'll explain why it's easy enough for people to do themselves. I've had more clients than I've ever had in the past year opening their SIPs or ISAs with Barclays or Hargreaves. And I was down at first thinking, oh my God, I don't even know how to do it. And they say, oh, it's just like opening a bank account. And then buying the 20 funds or stocks, working out their risk appetite, which I'll come to as well. And they realize, oh, actually, that's a hell of a lot better. Okay, so I will come to that in a second. The FTSE 100, if we get a recession, perversely, this will first dip, then rise. The best chance of the FTSE 100 doing well is if we get a recession. Okay, arguably, if there's a ton of talk of a recession, we just narrowly miss it by 0.1% or something. But that's the FTSE. Why do I want to invest in a market where we're talking about recession and low growth and high taxation? Of course I don't. Hence why, from my first column in the Financial Times in 1999, the opening paragraph was, I'm selling all my UK holdings and buying US ones. Well, you tell me how the last 25 years have gone. Forget the last 25 years, just how, I'll come back to that one, just how the past year's gone. Okay, another really important lesson, particularly for those with St. James's Place, IFAs, wealth managers, they're going to come after your pension because that's where the money is. We know this from 2024 because we saw it in 2024. It isn't going to get better. I'm sorry. They're coming for your pension. We've seen it in every country in the world, and it's going to happen continuously in Britain. That Sunday Times, £260 billion wiped off for the valuation of assets in pension schemes. They're going to do it in a number of ways. It might be how much you can withdraw tax-free. It might be how much you can put in tax-free. It might be reevaluating what the hell counts in a pension and then screwing you one way or another. They're going to do it. They're going to find ways of doing it. There's people today in the Treasury working out how do we get more of the trillions in a pension. That's been one of my number one lessons from 2024. They're coming after your pension in 2025. Now and beyond. Okay? Now, for me, what that means is that I still got to do what I've got to do. I can't worry about things I can't control. I can worry only about things I can control, and even those I can't really control. I've just got to put myself in a position to be lucky. Okay, now take this from Bloomberg. Now, when I used to do my Bloomberg TV show, one thing that I quickly realized was Bloomberg are absolutely the best in the world at what they do. There's very few places in the world which are the best at what they do. So when it comes to financial information, data, news, Bloomberg are number one. Hands down, that's it. Okay, so anyway, that's why I keep referring to Bloomberg in case you're wondering. Now, what my job is limited. My job is limited by how often I get a tailwind. If I get those kinds of returns, and 5 years out of 25 I do in the market, then I do incredibly stonkingly well and fill my boots. But there'll be a few years I've got to keep an eye out for and make sure that I tell people, right, we need to be in cash. Now, if I can even halve those and only have -7 or -5 or -2.5, that makes a ridiculously large gain for the years in which here you're just sitting back doing nothing. The biggest problem in 2024, one of the biggest problems in 2024 was people trading in and out. Whereas actually when they look back, they realize, shit, I should have just sat on my hands for most of the time, if not all of the time, right? Most of the time I got to sit on my hands. That's my job. Do nothing, right? Let it take care of itself. And as my wife said to me, you know, when Michael Bloomberg became mayor, we got a message on our Bloomberg terminals. And it was a message to everybody in the organization. And the message was, don't F it up. Right? So what my wife says to me, don't F it up. Okay. My job is to sit on my hands and not F it up. Just don't fiddle with it. Now, academic research shows, and I've published it in here, men are more likely to fiddle with their portfolios than women. If you're a man and you've got a female partner you can discuss your portfolio with, I recommend you get them involved, not only for female empowerment and education, all those things, but for the very same reason I tell my wife when the car's due an MOT, there's nothing in the marriage certificate which says it's my job. You call the garage, sweetheart, right? There are no male jobs and female jobs. I keep telling her, taking out the bins. Anyway, on a serious note, my job will be just that then, not to F it up when those years happen by making sure I go into cash. Got it? The other thing about they're coming after your pensions is this. The poverty gap between US and UK pensions is going to increase. Why? Because it is so, St. James's Place, IFA wealth managers are so UK-centric in what they hold. They'll fob you off with the odd American one, and then they'll say, the volatility of those American companies, it's all crazy. That Donald Trump, that Elon Musk, who wants that kind of money? It is our political culture. It is our culture in Britain generally that, well, until the 1980s, even saying the word entrepreneur or wealth was considered pretty dirty. I mean, oh my God, you earned your money? You didn't inherit it? Okay. I was born in Leeds, and it shocked me that, because I had really two cultural influences, British and Indian, and it shocked me how much the British didn't talk about making money. I mean, Richard Branson did eventually in the 80s, and that was about it. Okay. The Americans are one of the reasons their attitude has led to that gap. Now, the American pensions and portfolios will be more tied towards these kinds of returns. They're not necessarily going to happen forevermore, but anyway, we're just looking at the last 10 years. That gap is going to widen. If you don't believe me, just look at the two governments right now and what their focuses are. One is about increasing tax, because there's a big, and reducing spending. And the other one is about lowering corporation tax, which they've said. And you might think, well, wait a minute. No. Trump talked about tariffs. Surely tariffs are a tax. They are. You know what happened as soon as he got in? The currency appreciated so much that any import duties will have been cancelled out by the lower cost of importing those goods. That means Americans can now afford foreign goods more cheaply. He needs to put bloody tariffs up because he's got a strong dollar policy, i.e. to make imports that much cheaper. But it's ingenious. So who suffers? Well, in a way, the government benefits. This was a review that came in just a couple of days ago. About the program, how we do it. It is critically important in 2025. If you do nothing else, please stop trusting the experts. Please get the data for yourself, whether it's through my program or through Yahoo Finance or wherever else. Get the data yourself and get the education yourself. And I'll give you the data for free. Yahoo Finance has a lot of data. If I'm not providing it, it's going to be harder work for you, but so be it. Education, start with that. Okay, and it's free, and it's on the files that I've just given you. All right, it's free, and it's on the files that I've just given you. right? So education and data. Data without education is useless. Education without data is useless, right? You need to be empowered as he was. He's got 65% over 2 years. Well, it was a good 2 years for the market. I will, of course, take credit for it because I put him in a position to do it. However, it was a bloody good 2 years for the market. My job in a bad year for the market is not to find companies that don't exist and suddenly say to you, buy into this because it goes up. And I'll show you that in a second. That's an impossible task, which I don't set myself. My job is to tell you to hold cash and just, stay out of the bloody rain in those years. All right. That is critical that people understand this going into 2025. Now is the best time for you to take action because a bit like gym membership, you're more motivated around this time with your New Year's resolutions, and you got a bit more time because of the break to actually sort out this problem, which is of low pension performance, which has been bloody nagging you for donkeys, to sort it out now rather than wait and leave it another year and then think, oh God, my pension's still not growing, and missing some of the biggest all-time highs in the stock market. By the way, in case you don't know, your pension is invested in the stock market. People find this difficult to believe. Okay. And by the way, for the cash element, somebody asked me recently, what about the cash element? There are some good alternatives. So I researched this for them. I've been using for the cash element, if you just want to have cash, this is not an endorsement. I've been using them. I've been using Flagstone, and I came across Raisin as well. For Flagstone can do corporate accounts, so there you go. And those are ends up in bonds. Now, you might not give it to Alika Bank. You think, who the bloody hell are they? You might say, you know what? I'll give it to Sainsbury's, which is on here, or JP Morgan, which is on there. Okay, so that's one. There's something called Raisin. This is not an advert or a recommendation. I've not spoken to them other than having opened an account. Raisin funds. They've got some. This is for your cash part. Let's just work it out. Raisin. Here we go. High interest accounts. Okay. So that could be, again, please, it's not an endorsement. All right. Just so you know. And I only looked at this about 1 a.m. last night. So you might say, well, who the hell are LHV? I don't want 4.7%. They're regulated and they've got various, what's the 85,000 is the limit of the guarantee that the state gives you should they go bust or anything. Not that there should be any reason to, but yeah, they're regulated anyway. Now this one's got slightly less high street names, but they're all UK regulated funds for cash. It basically goes into bonds. Okay, it goes into bonds. We're talking about growth. We're not talking about, so idle capital, that's one place. Not my specialty, but I've come across that. Okay. Deva, do you ever see a case where UK government limits ISA amounts or decrease the earlier? Yeah, I do see that. I do see that case. I don't want to panic you, but bloody hell, if ever they find a place where people are growing assets and making money, and it seems easier than like rental properties for a while, right, let's get rid of it. Mortgage tax relief, let's get rid of it. Whatever makes mass people money seems to be taken away. Don't take my word for it. I'm not a conspiracy theorist. I'm not a grumpy old man. I'm just saying it just feels that way, doesn't it? Am I right or am I right? Which way does the trend go? Oh, shit, people are making money in buy-to-let. Right, let's kill that market. Oh, wait a minute, agricultural profit, kill that market. It's only fair. And you can justify all of it on fairness. Well, ISAs are a place where people who've got excess cash are able to get tax-free. Well, wait a minute, if you're going to tax schools with VAT, then why are you not taxing ISAs? Why should anybody have an ISA? Oh, because you're encouraging them to save. No, you've saved enough. Sorry, your lifetime ISA allowance is going to be capped. We've now decided at 500,000. Perfectly reasonable. Anything above that, when you withdraw the money, you'll get taxed a flat rate of 5%. Then next year, 10%, then the year after 15%, and gradually we'll just raid the whole bloody lot. Because guess what? There's a couple of trillion sitting there. Why not? If I was Chancellor, I'd be looking at it. And I guarantee you, if I've thought of it, I have a very simple rule. If Alpesh has thought of it and he's not that bright, then somebody else has definitely thought of it and acting on it. Right. That they're coming for your pensions. We know they are because they already have been. Okay. They're coming for your pensions, especially the workers' ones, because they already have been. This is the Financial Times, right? That's the Guardian. Pensions, why do those retiring face massive losses despite FTSE highs? Because Aviva pension drop. Why? Because they put their money in bonds. But surely, Alpesh, bonds are safe. No, bonds are linked to the price of the bond price. Okay, if the price of bonds falls because yields have gone up, because interest rates spiked in the bond market, then guess what? They can fall. These pension funds got screwed when Liz Truss became PM. And so did your mortgage. So, yeah, it's coming. In fact, no, I'm wrong. Sorry, I'm so wrong. It's 2025 coming up. It's already happening. It's already happening. Just read the papers, okay? It's already happening. They've already started coming for your pension. So your job is to make as much as possible. One of the reasons we launched this as part of the Great Investments Program, where for exchange traded funds, we look for the 40% trend. We look at other hedge funds, is because we said, shit, we've got to work even harder because we're going to need even more money because they're going to take more and more of it in tax. We know they are. It's not going any other way. Tell me I'm wrong. I wish. Okay, so we said, right, what we'll do is we'll look at the biggest banks, what they're telling their wealthiest clients, and we'll see if they meet our filters. We'll look at the exchange traded funds. Will they meet our filters and go 40%? The biggest hedge funds, what do they own? Do they meet our filters and go 40%? We increased, you'll know this if you're on the program, the quantity and quality of information coming out constantly. And the reason was because the bloody attack on the pensions made it clear, shit, we better make more money. Okay? Next lesson, an important one from 2024 for 2025. This, okay, the X factor. There's going to be an X factor. Know your drawdown danger, as I said, your volatility appetite. Never put more than 1% risk into anything which isn't the quality 5 plus. Now, quality 5 plus, if you're on the program, you know what that means. For everyone else, just assume every stock. You shouldn't put more than 1% in. What do I mean by 1%? What I mean is if you've got 20 stocks or ETFs and you put 5% capital in each, the stop loss is such that you shouldn't lose more than 1% of your capital if it hits your 25% from entry stop loss. All right? 12 months, 20 securities, equal money in each, which means 5%. 25% from entry stop loss. If it hits it, you shouldn't lose more than 1% of your capital, and the rest is in cash. Okay? What I mean also, this is a typical client, they sent theirs in, is lesson for 2025, make sure you know what you can know. You can know what your max drawdown is on a stock by looking at it historically and how much did it drop. In the case of Apple, it was 16%. So you know if I put that much money in, my max loss would be £8,000. Of course, it could go more than that, but the point is, why don't you just have that on an Excel? Why would you not do that? It's your pension. I get people saying, is there an automated way of getting a stop loss? I'm like, I tell you what, mate, just wire all your money into my bank account, please. Because obviously you don't care about your pension, don't care to look at it. You want to automate even an exit. Because it takes, thanks to telephones, it takes, do we call them telephones? Phones. It takes 5 seconds to look at your portfolio and see if anything's on Amber Alert. Amber Alert means if it's fallen 10% from entry, 10 to 15. Then you think, oh, better keep a closer eye on that. Maybe look at that one every week, just in case. The others, you don't have to do anything. Right? But you should at least have something which looks like this. Or as another client did it, he did this. He looked at the last drop and then the potential loss and the recovery time. Okay, and he set his own stop loss. Now that's important because you've got the ability to have that data. Why not have it and look at it and say, yeah, okay. It doesn't take long. We even give you this template so you can use it. Okay, you can use it. The X factor is going to happen where you're going to get sharp falls in 1 or 2 or 3 of your 20 stocks. If you've got 20 and you can have 40, you have between 20 to 40. And I'll show you the reason why in a second. That sharp fall will happen. Why? Because there's going to be a lot of X factors. It happens with CVS or the CEO of United Health gets shot. Now, if even as many as 4 of my 20 companies drops 25%, and one of them goes up 100% like an NVIDIA, then that one makes up for the other 4. So it's fine. Net, 0. I allow for even 4 out of 20 to drop 25%. But wait a minute, you got all this data. Yeah, I'd rather allow for a big buffer room. It's why I wear a seatbelt. Don't need it most years, but it's good to have. okay? Because there's always an X factor. And I guess it's more dramatically shown by what happened in 2024 about 2025, which is he came in, okay? Equally, on the flip side, the X factor means, yeah, AI picked this for us last May. It was on my Telegram channel. It was one of the ones which was on our list. AI then picked it out especially, and we said, oh, okay, well, let's amplify it because AI's picked it, and bloody hell, it's gone through the roof. X factor, investors rush into US equities. That's how much money's gone in since Trump. There's never been anything like it. I don't know, since 1929? I've not seen something like it. Stephen, money market funds are the same thing. It's just another name for what I've just shown you. It's exactly the same thing of what I've shown you. Okay. Yes, Paul, Hargreaves did come up. They've got this. Just look at the percentages. I'm completely indifferent to whether it's a Flagstone or Raisin or Hargreaves. It's just purely a numbers thing. Interactive Broker, I think, claimed to have some good interest rates. I don't know off the top of my head. I'm not endorsing any of these because I haven't physically, other than with Flagstone, put the money. And there it's gone to Sainsbury's Bank, of all places, a corporate account with Sainsbury's I never thought I'd have, but there you go. That's just cash. Okay, whoops. We're not talking my investments, which are more sophisticated than Sainsbury's Bank, but they offer a large interest rate. US in contrast with outflows elsewhere. That's where the money's going, and it's coming out of these places. So what do you think is going to happen in 2025? Can't guarantee it'll go up, but that's what it looks like. Okay, I'm going to end the FTSE poll. Only 18% of you thought it would go up next year. Let's reset that and ask you the same question with the US market. Okay. Lesson, if you're not relaxed at any point, this is a lesson from 2024 to take into 2025. If you are not relaxed with those investments during the course of the year, it's because you put too much in, you didn't have the data, or you didn't have the know-how. That's why you weren't relaxed, and it's important to be relaxed. Over this holiday season, film I recommend you watch is The Big Short. Okay, that's a scene from that film. Okay, drumsticks. If you're not relaxed, it means you've messed up your portfolio because you've either put too much money in or you didn't have enough information or enough know-how. My job is to remove those three gaps so you're always relaxed as Warren Buffett and live to 100 years like Jimmy Carter. We need to get you a bit relaxed. Okay? This was my son's junior ISA back then. For junior ISAs, the way I'm relaxed in my son's portfolio is he'll have 4 or 5 securities. That's it. So will my wife. Mine will be more sophisticated, okay, in their ISA, not the SIP, ISA. My son doesn't have a SIP. He's 6, okay? This isn't his current holdings, by the way. That's from back then, all right? So just so you know, I keep his simple. People sometimes ask me, is it a mirror of yours? Do you put 20 stocks into a junior ISA? No, junior ISA can hardly hold any cash. Back then, I think it was 4K when he was born, all right? So that's how I do it. I joined in 2021. I really got deep into investing following Alpesh Weekly Guide around 15 months ago and have returns over 60%. So things going really well. Lifetime ownership was always key for me. I was too busy running my own business, Technoworld PLC in the early stages. Brilliant. Okay, that's what I want. That ease and comfort that they've got something for life, but they don't have to keep paying subscriptions, and they've got access to me, and then that's it. They've got the data. My team does all the hard work for them because he's busy running his own business. My team gives them the data. Okay. So, and then they have the calls with me like a one-to-one Oxford University tutorial. And that is the model that I've used, the one-to-one Oxford University tutorial. Okay. Where you have a one-to-one with me, as many as you want, because that's the best way to learn. We know this because it's the #1 university in the bloody world. Go Britain. Okay. But also part of that knowledge is taking everything that I've written in those 200 columns in the Financial Times, which were largely reliant on the work of 3 individuals. I'll let you into a secret. Eugene Fama, Daniel Kahneman, who passed away in 2024, okay, and Richard Thaler, okay? They all went on to win the Nobel Prize in Economics. And God knows the number of times I commented on them and said, oh, they've just done this, they've just done that. It's really easy writing those columns in many ways, okay, and in those books. It's important you have that knowledge compressed, because what you want is not to learn that from scratch. That would be stupid. Equally, you don't want to outsource it to someone. That would be stupid. What you want is you to have it by having your personal tutor, like a personal trainer, say to you, right, we're going to do these 3 1-hour calls. I'll teach you to drive. That's what you actually want. That's the optimal learning to drive. You might think, oh, no, I want a chauffeur. Let me just outsource it to. Worst thing of all, giving it to a St. James's Place is like saying, here, take my Rolls Royce. Here are the keys. I won't even sit in the car. You just go and drive and enjoy it. Then come back to me with the tank empty and depreciation on the car. That's what they do. Okay? You've just given them the keys to your crown jewels. They come back with it all knackered out. It's better you enjoy your own car and I teach you how to drive. That's my model, okay? That's my model. Similarly with this, I've hardly been in touch since joining GIP in 2021. Some of them don't get in touch now. Often they don't need to. Portfolio gone from 100 to 400. I can't guarantee that. I'll take credit for it. Actually, I don't deserve to take the credit. The stock market did it. I put him in a position by giving the data and the know-how to have those companies. But I didn't invent Apple or Walmart or Costco. I wish I did. Or JP Morgan or Goldman Sachs. I wish I did. I didn't. Okay? And that's what people don't realize. Not picking, well, picking the companies in the sense of telling you what's all green, but actually you're picking them based on your risk appetite to see what suits bespoke. This is the Savile Row of treatment. It's like we give you the data and then you say, Alpesh, can you just check that the suit fits? These stocks exactly fit my risk profile. So it's suited to your risk appetite, because one man's meat is another man's poison, as they say. For one person, a volatile stock is suitable. For another, it's not, even if both get the same return. Okay? Because one of them will have mental anguish during the course of the year. The other one will be comfortable with it. And that's why we work out what's suitable based on, it's like me putting on tight clothes. Don't look good the way Tom Cruise does in them, as I keep telling my wife. Watch for the once in 5 to 7 year exit to cash diversification, to go into cash. Diversification will not save you. This is 2025. Your IFA and wealth manager is going to talk about diversification so they can sell you more funds and earn more fees. It's not going to save you. We know it's not going to save you because this is what happened to the Dow 30 companies in 2008 when there was a crash. They all bloody fell. Okay? They all fell in 2008. Where's the diversification? Oh, Coca-Cola's a drinks company. It'll be diversified, Alpesh, from Verizon, which is a tech company. No, it wasn't. Sorry, they both fell. Where's the diversification? And when they're all falling, are you really going to be the only person who puts your money in McDonald's? No, I haven't got those balls. Have you? Everything's falling. Intel's down 45%. Johnson & Johnson's down 10%. Microsoft's down 45%. Apple's down 56%. And you say, I'm going to put it all into McDonald's. You got those kahunas? I haven't. I'd be holding cash. Okay? Actually, in 2008, we were still very much trading rather than spending so much time investing. So it was all going short the market, particularly in the car companies like General Motors. Lesson, big gains. This is an important lesson from 2004. Hopefully it'll happen in 2005 where you get some massive gains like Broadcom or MicroStrategy or whatever. If it drops X%, sell Y%. That's the rule. If it drops X%, sell Y%. Okay, so 76% of you think the Dow will be up in 2025. I'm worried because usually retail clients are wrong. I'm not worried because of the reasons I said. If there's a tailwind, we'll do well. Otherwise, we've got a strategy. When do you reduce stress? When you've got a plan. So we've got a plan, so we know. And the plan is, as I said, 12 months, 25% drop on any, tick all the boxes, value, growth, income. And if any of them like this on a big gain, this is a big gain exit, okay? So it's an exit only for the big gains, say 50% gains, 100% gains. If it drops X, sell Y. Y is dependent on your risk appetite. It's dependent on your risk appetite. So we get some clients saying, look, Alpesh, it's gone up 30%. It started with a 50% allocation because it went up. I had an additional 50% allocation, adding to winners. I won't discuss that in this one, but that was an important lesson from 2024. 4 for those who are risk averse, add to your winning position. So start with a smaller position. Don't go in with your full allocation on day one. Just add to it as you make profits. If you're risk averse, if you're risk loving, you wouldn't do that. That's why we get our clients bespoke risk right first. It's very important so that they're always at ease. Okay. If it drops X, sell Y. And Y is dependent on your risk appetite. If we knew what the future held, I'd tell you exactly what X and Y should be. We'd be able to solve that equation for perfection. Because you don't, you've got to choose it on your appetite. Okay. Remember, I first joined, you mentioned you were going to buy it. Yeah. I will sometimes talk about things like, which are not in the program for my clients. We meet up. That's another thing. This was Ripple. It wasn't in the program. This chap, I don't think you'll mind me saying, Ravi, got into it, 254% up. The point is this: we will do in-person events. We do this and do meetups. I met up with clients in New York. The program is created not just to give you the data and be hands-off. It's like nothing you've ever seen. It is so that we can also meet up as and when people wish. And I do 4 events in Parliament a year. If you've not joined me on LinkedIn, do. Okay. Because you'll be invited. Where's the one? Here we go. I just put a picture up of one of the clients. So that's with Joseph in New York, which was a couple of months ago. And that was a great lesson out of 2024. And I've written an article about it. It was one of the things that I've just really enjoyed is meeting the individual Great Investments Program clients. Absolutely loved it. So do go to my LinkedIn. It's alpeshpatel.com/links, by the way. Okay. Sorry, I know I've overshot, but if you don't mind, I'll continue. So many of you are still here. Partly out of interest, these were the companies that they bought. Again, gone up 50%. What should I do? And I said, well, we're not trying to see into the future. What we're saying is if it drops X, sell Y. Otherwise, you hold for 12 months. But some don't want to do that. Okay, very simple exit rule. It stops indecision. It stops trying to trade the markets. Don't try and trade the markets. Okay, 12 months. 25% from entry, or if it drops X, sell Y if it's a big gainer. Follow your process, check all the boxes, remove the areas of chance. That is going to be critical in 2025 now that the market's a bit more toppy. We will ensure we continue following our process. That lesson for 2024 is the same lesson we're going to take into every year. Now, what are these? We're looking for companies which are undervalued and growing. Your St. James's Place and your IFA will say, oh, no. We've got a value fund and then we've got a growth fund. So we've got shit fund number 1 and shit fund number 2, and we're going to mix the two because shit and shit makes really good. Excuse my profanity. I apologize. Well, no. And they make me angry at their incompetence. And I've written about their incompetence 20 years ago. 25 years ago, and there's 17 other books over my shoulder which also have written about their incompetence. And not just them, it's industry-wide. Because they're trying to sell you more than one thing because they make more money. Well, why don't we just have stocks which are undervalued and growing, i.e. growing revenue, growing profits, and the share price is low compared to their profits. Cash return on capital invested comes from Goldman Sachs Wealth Management. I don't have a monopoly on the best idea. Sortino is really easy. It's a cheat. I cheat. This is how I cheat. We take the stock price, we look at the average returns, and we look at the volatility or the risk of missing it and how quickly it rebounds. And we want that to be a quick rebound and a small drop. That's called the Sortino. It's a mathematical formula. It's used in the hedge fund industry. It's used in my industry. I set up my first fund in 2004, and it's when I really realized all the wealthy clients we'd go see in Switzerland or Aegon or AXA, they would say to us, or family offices. And our first investors in the hedge fund were, for instance, the founder of Cobra Beer, the founder of New Look. And their family office people would ask Sortino. And if they didn't, we'd explain to them why it's important. Okay, so we want stocks with high Sortinos. This is from Goldman Sachs Wealth Management. Now, some say it's a bit conservative. My wife tells me I've got 25 years to retirement. So I'll continue in 2025 at the moment having 90% of my capital in equities. However, if you're a bit more risk averse, then you'll be closer to this, and you might have more in exchange traded funds, more in cash, your 4.7%. The cash you have, a bank doesn't have a tree it plants your money on. It puts it into the bond market, yeah? Or other investments, but generally bond market. Okay? So it is fixed income. You might think, oh no, I've got to go and buy those bonds myself. I bought my first set of bonds from the post office when I was about 12 years old. My aunt lent me £100 and there was a form you could fill in, bought some bonds. You can do that, I think, still, probably, directly from the government. I think, I'm not sure. But nowadays, most people go online and just give it to the bank and they'll pay the interest and you get your 4.7% or 4.8 or whatever it is, okay? I think Close Brothers Savings are giving 6. Check it, Close Brothers Savings. I'll have to have a look at it in more detail because there's sometimes a catch that it's only for the first 3 months, but you're locked in for 12 and then it drops to 3.5. So in actual fact, you see what I mean? There was some kind of catch. It's finance. Okay. These are the important factors. We will continue doing our process. Value growth, it's going to be more important than ever in 2025. We'll monitor infrequently. Why infrequently? Because we don't trade. We don't want to panic. Okay. 12 months, 15 to 40 stocks, 25% from entry and exit, or if it's a big gain, if it drops X, sell Y. Right? And that's why that many. If you have over 40, you're just creating a bureaucratic nightmare. Some people like to buy loads of everything. If you've got less than 20, you've got individual company risk. Market risk can only be removed by holding cash, and that's like 2022. And my job, I'm sort of like, think of me as a lighthouse watchman, is to remove that risk. Okay, I've written about all of this elsewhere previously. Okay, to learn more, go there. alpeshpatel.com/links. Have a look at this. We've not finished. Have a look at this as well. Campaignforamillion.com. My campaign to teach 1 million people how to invest better. This is what I meant about the projections. We will continue looking for stocks with projections at least 40% to the upside. And the downside, the drawdown, remember, drawdown danger equals how much it drops times duration to recovery. Okay, you've got to know your numbers for that based on your risk appetite. Lesson, we don't have a monopoly on ideas. Cross-check to filter further. Do you know what? I've gone on too long. I should probably stop there. I'll run through this bit really quickly. So we do look, because we don't have a monopoly, and we'll do this in 2025 again. We'll look at hedge funds, which are generating 40% returns over the last 3 years, at least 3 years, like this one, a $4.7 billion hedge fund, which generates 53% returns. And then we'll drill down and see what stocks do they have and do any of their stocks meet our criteria. And if they do, then we'll say, right, let's go into those ones because they meet our criteria. That approach where, and we've been doing it since, well, a number of years, where we just said, well, we don't have all the ideas. That's what we'd look at the hedge fund ownership reports. We'd look at all of these hedge funds. Okay. And only the ones which have got 40% per annum returns for the last 4 years. And then only if it's on our list. If it's not on our list, we're not interested because they might have held it for years. They might be about to sell it. So only if it's on our list. So it's an idea generation approach. So take this one. This is from years ago. 51% per annum return over the past 3 years. He was holding these years ago. So I'm showing you an old slide. We've been doing it. Does it work? Yeah. Because this is from back then. You just have to look at how they've performed. We'll do the same with billionaires. Just out of interest, what do they own? What does Bill Gates have? What does Soros, Jim Simons, who passed away in 2024, Warren Buffett have? His partner passed away in 2024. Okay. Not because we want to buy them, but should they also be on our list? Great. We'll then do the aggregate of what do all the biggest banks and funds have out of the S&P, and do any of them hit our list? And if so, we'll have them. Another lesson, the Quality 5 Plus is expanding. Exit on a daddy bear rule. What do I mean? Well, we have our Quality 5. We added more names to those. We're going to add more names to those. These are ones which consistently, year after year, generate very high returns, very few down years, very shallow drops, very quick to recovery, okay, and very infrequent where you have to go into cash like 2022. And you can apply the very simple daddy bear rule. We'll continue doing that with the Quality 5 Plus. We'll continue owning them unless they're in a daddy bear, and they'll be the bulk of our portfolio and what will generate us the 30, 40, 50% if there's a tailwind. If there isn't a tailwind, we'll have to hold cash and get nothing. Leverage on low risk. We will continue leveraging. This is an old portfolio. So I continue holding these for donkeys, and you can imagine this is about 3-4 years ago, how much the leverage ones have risen. Now, leverage is for nobody on this webinar because leverage is irresponsible unless you are a very sophisticated investor. But to go from 10,000 to 25,000 in 2 years, yeah, that's what I want with leverage. Okay, that's why we do it. And we will continue focusing on that for the few clients who want those kinds of returns and are aware of the risk. So 4,000 to 12,000 in 2 years. Yeah, tripling your money. Okay, we will continue focusing on our quality 5+, which will be the essence of the portfolio. We'll leverage on the ones where the downside volatility we've looked at statistically isn't too great. Now, this is very bespoke. It's only 10% of my clients who want leverage. 2 times leverage means if Microsoft goes up 10%, they make 20. If it drops 10%, they lose 20. So it's for a very few select group of clients who want to do that. But we'll do it only on those which meet all those criteria. Okay? I won't go into all of these now. It's getting to, well, actually, no, this is the last slide. Keep your eye on the prize. The prize is this. How long does it take to double your money? Now, if you're with St. James's Place, an IFA and fund manager, that's how long it's going to take, 14 years. They'll try and sell you that they can do 10% per annum and get you in 7.3. They can't because they never have. All right. And they're not going to do it. What I want to try and do is even if I just hit what the market does, then I want to try and double it here. Now, I'm not too bothered whether it takes me 5 years or 3.8 because there's a limit to my greed. Okay. I'm not bothered it's 15 or 20%, but you can see I'm certainly not pissing around with just waiting 7 years or 14. Okay. Simple as that. How does it do? Well, I'll just go by the general statistics for you, shall I? Average return 32% on the S&P over every 2 years. My first column in the FT, 1999, I'm putting all my money into the US market out of the UK. And I didn't have this data point, but bloody hell, it vindicated it as well. So that's why I'm saying, what am I looking at in 2025? Well, actually, I'm going to tell you what I'm looking at in 2025 and 2026. I'm going to look at this. I've got an 88.5% chance of getting a positive return, and I'm looking to up my pension by 1/3 over those 2 years, worst case, because the data supports me doing it. And my one job will be to make sure that if we get a daddy bear, I go into cash. Okay, that's it. That's my job. And as Trevor put it, I want to repeat in 2025 what I did for Trevor in 2024. I want to repeat in 2025 what I did for Trevor in 2024. It's simple as that. That's a simple goal. I want to do that for every client. That's my goal. It's out of my hands because it requires the market to have a tailwind, but at least the clients will have it in their hands because they'll have the cash in their hands. They'll have the brokerage account in their hands. They'll have the decision-making and transparency. If you want to see how we do it, you'll see some videos. Have a look at alpeshpatel.reviews.com. Lesson, anyone can do it. Somebody just asked me, I'm with St. James's Place. What do I do? This is what you do. Anyone can open a SIP. Well, it doesn't have to be Barclays. It could be Hargreaves, it could be AJ Bell, it could be anybody. It's just like opening a bank account. Put your details in, you fund it, okay, and then you pick what you want to buy, and that's it. It's that simple. But people think it's complicated, okay? Keep away from the fund managers. There's going to be more of these. I guarantee you in 2025, my prediction, more apologies for poor investment performance from fund managers. It's coming. Okay. That's the column. I'll leave you with that and I'll answer any questions that you might have. I'm going to share more files. Okay. I'm going to share more files with you. If any of you'd like to get in touch, happy to give a tour. If anybody would like to join the program, more than happy on this webinar to take people on with a 40% discount. It's a one-off charge for life. You've got lifetime access. People find that very difficult to believe. The reason is so you know upfront there's no conflict of interest. We're not trying to keep you in when there's a down market. We'll just tell you the way it is. Okay? Been switching virtually all of my long-term holdings. Yes, UK, that's 1999. I looked that young then. And this is 2024. That's what it's like. Okay, that is Blue Whale. They'll advertise like crazy. You ask your IFA and you ask your fund manager, you ask them, what did you do in 2022? We got 0. We got slightly more than 0, but call it 0. I'd rather you called it 0 than what we got, which was a bit more, but it doesn't matter. Call it 0. I can afford to be magnanimous. Call it 0. You'll see it on YouTube and everything else. We said, well, we don't find anything in January. Let's wait till February. February, we don't find anything in February. Let's wait till March. Blue whale. Lots of people, lots of IFAs gave them their money. They lost a quarter of your pension. Scottish Mortgage Investment Trust lost half your pension. Isn't it better you hold it? We will continue doing all of this work for you in 2025. All of that data for you. If you want to see the other results like 2020, 2021, 2022, I've already discussed, 2023, have a look at the website, alpeshpatel.com/links, and it'll be able to take you onto some of the good ones, and we don't know which ones are going to be phenomenal, pay for some of the ones which weren't so great, and that's why the average is below the best. The average is 54. I wish it was 208%, but then that'd be witchcraft. So our best pick was that, but the average is 54 because there were loads which did less than 100%. That's just the nature of the beast. Okay. That's 2023. We'll put up 2024 once we've got all the data ready for that and see what the return is on that, on the further filtered list. Okay, we'll put that up. Let me see. That was the Broadcom one, which started playing around with AI. This is what people want. They want us to do the work with the data and give it to them, which we give them for life, and have the calls with me. And we have a little form. Oh, I want to create an asset management company and I want to float it. I want to create an asset management money spun out of my hedge fund using the data that we use in the fund. The asset management company would mean you keep the capital. All you get is the data and the education. That way, you've got total control. That way, you've got all of that, but without having to give your money to someone else, without having to pay fees all the time. If you'd like a tour, Paresh will be more than happy to give you a tour and discuss it all. Thank you, David. Thank you, Nick. It is on the website with the 40% discount. I will just click that link and it'll show you the exact numbers. It depends whether you're in the UK, in which case there's VAT. If you're a company, you might be able to claim the VAT back. And if you're outside the UK, there isn't VAT. There might be local sales tax, but like if you're in America, you don't have to pay the VAT. We already have import tariffs, basically, in reverse. See, import tariffs people criticize. But VAT is a punishment to British people because they've got to pay 20% more than an American has to pay. We've got the reverse of an import tariff. We're just going to selectively punish our own people. Not, at least Trump tries to say, I'm punishing the Chinese by putting an import tariff on. Okay. So have a look at that. That's the link. It's 40% for now. We're going to be putting the prices up again because what we do, a bit like inflation, the stock market was up 25%. We've had, obviously, a hugely successful group of clients. A bit like Bitcoin in circulation, as the number of memberships becomes fewer that are available in circulation and the returns people make go up, it's only fair we increase the price. Just out of fairness, it's not because our costs have gone up because we provide more data and more information than ever, and the more we charge, the more we can provide, but the price will be going up. It won't affect you if you're signing up today, and the discount is there as well. Oh, there you go. There's the price, including VAT. If VAT is not included, it's 20% cheaper than that. Okay. Thank you all very much. Hope you liked how it was provided. If there's any questions I've missed, do send it in. What sectors do you think might do well? I didn't go into sectors, and the reason is I ran out of time, but I don't look at sectors, I look at companies. So I don't care about sectors, and partly because sectors are often misnamed. If you look at Meta, it's a communications company. Well, I thought it was a tech company, so did you. So the sector thing was suitable many years ago. What do you think of quantum computing? I think it's going to be very important, Lillian. I did put on my Telegram for my private clients 2 or 3 quantum companies for fun, pretty much. I said to them to look at, where's the reports? I did a stock report. So what we do is we now do stock reports as well, which is a new thing out of 2022. And I put a few companies in there on quantum for them, 2 which are pretty well known and have gone up about 300, 400% since Trump came in, but I think it's critically important. We don't take a punt unless we've got it all on our green spreadsheet, value, growth, income. is in there. Okay. Thank you all very much. If you'd like me to save you a place, let me know. Yes, it's 24 installments. So you can do it in installments, or you can pay one off. Entirely up to you. Okay, and these are the benefits. If you want to have a look at all the benefits of the program, because there's a whole load of education you get, not just one-to-one tutorials with me. We literally stole the Oxford University model, and not just the data, which are the two. I mean, the two most important things people want is the data and access to me. I have a whole team, as you can imagine, around the world who provide the data for me. We have a graphics team and a data team. They're the two main parts of the team. And we've just added to the graphics team somebody out of, oh God, where is he? Might be out of Ukraine. I've got to work out where we've just hired the guy because my brain's getting fried. That's what they want. They want all the data, and they want me to bespoke fit it. And sometimes they make the foolish mistake of asking, well, what do you own? And I tell them what I own. And I say, but hang on, I've got 2 private jets in the back garden. I don't. But the point is, you want the bespoke volatility and risk suited to you, and you want me to check, this suits them. So we have this wonderful little form that I created called 7-minute pension, which in 7 minutes, it takes you to read. It might take you longer to fill. With our data, you can work out, this suits, this doesn't suit, this fits, this doesn't fit. Now, the reason for that is it simplifies it for you, but it allows me to look over your shoulder and say, right, you've selected things which fit your, Graham, it's 24 times in case confused. Yeah, exactly, Graham. It's 24 times. Is that not clear? I apologize if that for any reason is not clear. It is very, very clear on the website. So don't worry. We've never had a case of somebody being confused. This is the direct link. What I want to do, once we've got a bunch of people on here, and we've got to about 300, we've got an online community this year, and we meet up in person as well around the world. We've got an online community, so you can do a one-time. Oops, there's the one-time. Okay, with the discount. There's the discount code. Or you can do it in installments. Okay, there you go, with the discount code, with the coupon code. Don't worry, you can email me before you press it. So if you're confused at any point, all of those are discounted. Every installment's discounted as well. Sometimes people get confusing. It's just the first installment. No, all of them. And you don't have to do installments. You can do it in one go. Thanks, Nate. Thought so. You send me a place. Yeah, absolutely, Christopher. More than happy to do that as well. And if you'd like a tour. It's been most popular with people who are busy professionals or people who've sold their businesses or are retired. I guess those are the 3 main categories, because all 3 of them have found different ways of thereby managing their portfolio. What the retirees have got the time to monitor it. The busy professionals got us to provide all the data so they don't have to spend as much time on it, and it's helped them that way. And then this explains why it's so much easier. It doesn't take up your time. The reason it doesn't take up your time is because once we've got you to the stage of your portfolio, then you're just watching it. And we provide all this education, but you don't need this. Most of my students don't go through the education. They don't need to because they have the one-to-one tutorials with me. I get a few who say, well, I'm retired. I want to go through all of this, which is great. Every teacher wants their students to know and understand the market. So we give them all of this if they want it. Yeah, they're more than welcome to read all of this and give them exec summaries if they wish. But actually, most of them don't do that because they say, well, wait a minute, I've got the portfolio. I don't need to do all that. I'm going to go and be a surgeon, as we have got. Jean-Francois, what should happen is, and if there's a problem, just email me, the browser will pick up which country you're in on your IP address, and it will say, you're in a country where there should be no VAT. So it should have removed it. If that hasn't happened, for any reason, you might have cookie blockers or whatever, or IP non-tracking, which sometimes happens, please email me and we'll just issue the invoice directly to you with your foreign address so that you don't have that problem. We're VAT registered, so HMRC requires us to have evidence that you're not. So an address, for instance, or IP address when you signed up would be sufficient for HMRC to know, they're not in the UK, therefore they don't have to pay. Otherwise, the taxman would say to us, why did you not charge them VAT when you should have? So that's why. So the payment processor takes care of it directly. So you can either go to alpeshpatel.com/shares or /shares2. They'll both work on the same way because all of these payment processors are obliged by law to work the same way. So it should remove it. If not, just email me. Okay. So yeah, we give them all this education, but they tend not to be bothered about the education because I'd given them the one-to-one tutorials like at university. And as I said, at the moment, we've had more people interested than ever because it's that time of the year when you've got time to sort it out and get on with it. And our job is to limit the amount of time you need to spend on it. And the reason is you've all got better things to do. I'm the only one who's obsessed. Well, me and my team are obsessed with making sure you've got the data and everything else. We do the work for you and then make it bespoke based on the volatility and the risk. Anyway, I better go because I've kept you all for so long. Which email address? Oh, sorry. Apologies. alpesh.patel at tradermind.com. Okay. And I'm sure before the year before the year's tomorrow night. So yeah, I'll do another broadcast maybe on Friday, which might be a repeat of this if that's what people want, just because there's just so much to cover. I'll just show you something else on screen. So we'll be looking for this. We'll be, during the course of the year, this is the S&P. We'll be making sure if that happens, we're in cash. If either 2 or 3 happen, we don't need to worry. 3 is called a baby bear, that's called a mama bear, and that's a daddy bear. That'll be the main thing I'll be watching out for in 2025. The main thing. The reason I say your risk appetite is really important to me is this. Your risk tolerance is what we spend a lot of time working out. Not because you'll get lower returns, but because you'll have less choice, which is fine, to still get the same returns, because we want to avoid anybody having emotional distress during market downturns. And the best way to do that is to know your tolerance to begin with. It's as simple as that. It's as simple as that. Okay. I think that's everything. I think that's me done. Thank you all very much indeed. Christopher, I'm holding a place for you, so not a problem. And I think there's a load of files we've shared with you, so that should be fine as well. Listen, thanks everyone. And let me just close this window. There we go. Happy New Year to everyone else. I'll do more market updates into 2025 as well, because I love this stuff. Don't forget, you should have had the file to download a copy of Investing Unplugged. Really proud of it. It's one of my, as I say, 18 books. The others are over my shoulder. I got the YouTube thing in 2024 as well. The silver plaque you can see there. This had wonderful reviews. Please do download and read it. It's got wonderful reviews from a $2 billion hedge fund manager, from Bloomberg TV presenter, from Financial Times columnist, and from Shares Magazine, and so on. Wonderful reviews on the back cover. And it's not a big book to read. It'll explain some of the information that I've told you here on this, in particular, the data from Nobel Prize winners, but why the fund managers underperform year in, year out. And you can see it here. And that's from 2000. I've gone down. There's a whole bunch of funds I mentioned then which have underperformed and why they do it. And we show them in the data. This is all free. Get the whole book for free. And it was an international bestseller for Macmillan and myself. And it's one of 18 I've written for the Financial Times on this subject. I set up the hedge fund after that in 2004. So Happy New Year, everyone. And thank you very much. Oh, I think that was my phone. I better go. That might be my wife. Okay, everyone. Thank you and goodbye.